Section 1:2 Introduction to Beta 1.2 Importance of systematic risk. Systematic risk and unsystematic risk are two components of total risk in an investment portfolio. Here's how they differ. Systematic risk, also known as market risk or undiversifiable risk, refers to the risk factors that affect the overall market or a specific segment of the market. It is uncontrollable and affects a broad range of assets. Systematic risk is caused by factors such as economic conditions, interest rate changes, inflation, political events, natural disasters, and market sentiment. Key points about systematic risk: market-wide impact. Systematic risk affects the entire market or a particular market segment. It is non-diversifiable, meaning it cannot be eliminated by holding a diversified portfolio. Common risk factors. Systematic risk arises from factors that impact a wide range of assets. These factors affect the prices and returns of various investments in a similar manner. Beta measurement. Beta is a measure of systematic risk. It quantifies the sensitivity of an asset's returns to the overall market movements. Assets with high betas are more sensitive to systematic risk, while assets with low betas are less sensitive. Impact on the portfolio. Systematic risk affects the overall performance of the portfolio. During periods of market volatility or economic downturns, assets tend to move together. And diversification may not provide full protection against systematic risk. Unsystematic risk, also known as specific risk or diversifiable risk, refers to the risk factors that are specific to individual assets or companies. It is unique to a particular investment and can be reduced or eliminated through diversification. Unsystematic risk can arise from company-specific events, such as management changes, competitive factors, product recalls, or financial performance. Key points about unsystematic risk: asset-specific impact. Unsystematic risk affects individual assets or companies rather than the entire market. It is diversifiable, meaning it can be reduced by holding a well-diversified portfolio. Unique risk factors. Unsystematic risk arises from factors that are specific to an asset or company. These factors may not affect other investments in the same manner. Elimination through diversification. By diversifying investments across different asset classes, sectors, industries, and geographies, investors can reduce unsystematic risk. Diversification helps to mitigate the impact of adverse events on any individual investment. Impact on the portfolio. Unsystematic risk is idiosyncratic and does not impact the overall portfolio to the same extent as systematic risk. By holding a diversified portfolio, investors can minimize the impact of unsystematic risk on their overall investment returns. Understanding the differentiation between systematic risk and unsystematic risk is crucial for portfolio management and risk assessment. By recognizing the sources of risk in a portfolio, investors can make informed decisions regarding asset allocation, diversification, and risk management strategies. Systematic risk, also known as market risk, plays a significant role in influencing investment returns. Here's how systematic risk can impact investment returns. Broad market movements. Systematic risk is driven by factors that affect the overall market or a specific segment of the market. These factors can include changes in economic conditions, interest rates, inflation, geopolitical events, and market sentiment. When systematic risk is high, it can lead to significant market-wide movements in asset prices and returns. Correlation with market. Assets with high sensitivity to systematic risk, as indicated by a high beta coefficient, tend to closely track the movements of the market. During periods of market growth or decline, assets with higher betas will generally experience larger proportional changes in their returns. Therefore, systematic risk can amplify investment returns in line with the market, volatility, and uncertainty. Systematic risk can increase market volatility and uncertainty. During periods of heightened systematic risk, markets may become more volatile, leading to larger price swings and increased uncertainty for investors. This volatility can impact investment returns, as it introduces greater potential for both gains and losses. Risk premium. systematic risk is compensated by the risk premium, which is the additional return that investors expect for taking on higher levels of risk. Investments that are more exposed to systematic risk are generally expected to generate higher returns over the long term to compensate investors for the associated uncertainty and market fluctuations. Impact on asset classes. Different asset classes may be affected by systematic risk to varying degrees. For example, equities are typically more sensitive to systematic risk compared to fixed income investments. As a result, during periods of high systematic risk, equity investments may experience greater volatility and larger priced swings compared to fixed income investments. Diversification benefits. Diversification is a risk management strategy that aims to reduce the impact of systematic risk on investment returns. By holding a diversified portfolio across different asset classes, sectors, and geographies, investors can reduce their exposure to the systematic risk of any individual investment. Diversification helps to smooth out overall portfolio returns and potentially mitigates losses during periods of high systematic risk. It's important to note that while systematic risk can impact investment returns, it is only one component of overall risk. Unsystematic risk, which is specific to individual assets or companies, also plays a role. By understanding and managing both systematic and unsystematic risks, investors can make more informed decisions and construct portfolios that align with their risk tolerance and investment objectives.